Right now, at this very moment, while you are sitting there glancing at your bank balance on your phone or your computer, someone else is looking at it too. And no, I am not talking about a hacker. I am not talking about some scammer cold calling from overseas. I am talking about the United States government. I am talking about the IRS. And what I am about to walk you through in this video is something most financial advisors will never bring up, honestly, because most of them do not have the full picture themselves. If you are 65 or older, or even approaching 65, and you have money sitting in a bank account right now, I need you to stop what you are doing and watch this entire video, because the way you are checking your account, the way you are moving your money, and the financial habits you have right now could be sending automatic red flags directly to the IRSI without you ever suspecting a thing. Welcome to my channel. I am Gilia, and today we are going to have an honest conversation about something the retirement space almost never talks about straight: Carol's story. Let me paint you a picture. Picture a retired woman named Carol. She is 67 years old, lives in Ohio, spent 35 years in the classroom as a school teacher, saved carefully her entire working life, and finally retired with about $280,000 in her savings account and another $190,000 in her IRA. Carol is not wealthy. Carol has not done a single thing wrong. Carol just wants to enjoy her retirement, spend time with her grandchildren, maybe take a few trips, finally breathe easy after decades of hard work. But one morning, Carol walks to the mailbox and pulls out a letter from the IRS, and it is not a refund check. It is an audit notice, and Carol is completely blindsided. She has never cheated on her taxes. She has never done anything illegal. But the way she was managing her bank account, the way she was withdrawing and depositing money, the patterns she had built up over years, all of it triggered something inside a system she never knew was watching her. By the time this video ends, you are going to understand exactly what triggered it. And more importantly, you are going to know how to make absolutely certain the same thing never happens to you. Before we go any further, I want to be completely clear about one thing. Everything I am sharing today is entirely legal. We are not talking about hiding money or breaking any laws. We are talking about understanding the system that is already operating in the background, knowing your rights as a retiree, and making smart, informed decisions about the money you worked your whole life to protect. That is what Growth Horizon is built on, giving you the information that empowers you, shields you, and helps you hold on to what you earned. If you are new here, welcome. If you have been with us for a while, you already know we do not sugarcoat things, and we do not waste your time. Hit the like button right now, and if you have not subscribed yet, hit that subscribe button and the bell icon so you never miss a video like this one. We release content like this every single week. All right, let us get into it. The Bank Secrecy Act and Currency Transaction Reports. Here is the first thing you need to understand. The IRS does not need to knock on your front door to know what is happening inside your bank account. The modern banking system is built on a framework of automatic reporting that the overwhelming majority of Americans have never heard of. It is called the Bank Secrecy Act. Under this law, your bank is legally required to report certain activity to the federal government automatically. No warrant needed, no suspicion needed, no crime needed, just specific patterns of financial activity that trigger a mandatory report. One of the most common triggers, one that catches thousands of retirees off guard every single year, is something called a currency transaction report, or CTR. Here is how it works. Every time you make a cash transaction of $10,000 or more, your bank is required by law to file a report with the federal government. That report includes your name, your social security number, the amount of the transaction, and the date it occurred. Most people hear that and immediately think, I never take out $10,000 at once, so I'm in the clear. But this is exactly where it gets critically important and where so many retirees get tripped up. The IRS and FinCEN, the Financial Crimes Enforcement Network, are also closely monitoring for something called structuring. Structuring is when someone makes a series of smaller transactions specifically to stay beneath that $10,000 reporting threshold. So if you were withdrawing $9,500 one week, then $8,000 the next, then $9,800 the week after that, the system is going to flag those transactions. It will appear as though you are deliberately attempting to avoid the reporting requirement. And that is a federal offense, even if you had absolutely no idea the rule existed. Even if your only reason for those withdrawals was cash for home repairs, a medical bill, or to help a family member through a tough month. It does not matter. The pattern is the pattern, and the system flags it automatically. What else the IRS can access? Now, here is something even more significant, something that genuinely surprises almost everyone who hears it. The IRS has access to far more than just your cash transactions. Through a framework that has been quietly expanding for over a decade, the federal government can now receive information from banks about a wide range of account activities. Interest earned, large transfers, and even activity on third-party payment platforms. In recent years, platforms like PayPal, Venmo, Cash App, and Zelle have been required to report payments to the IRS when transactions cross certain thresholds. So if your adult child is sending you money every month to help cover expenses through one of those apps, that could be generating a tax document you never knew existed. And if that money is not showing up correctly on your tax return, whether you understood it to be income or not, you now have a discrepancy on file, and discrepancies are precisely what triggers audits. How the IRS tracks retirees specifically. Let us talk about something that is very specific to people who are 65 and older, because the IRS actually treats your age as a data point. When you reach 65, certain financial events become expected. You are expected to begin taking Social Security. You are expected to start drawing from your retirement accounts. And when you turn 73, you are legally required to take what are called required minimum distributions, RMDs, from your traditional IRA and 401k accounts. All of these anticipated financial events create a kind of expected financial fingerprint that the IRS has on file for you. And when your actual bank and tax records do not line up with that fingerprint, questions arise. For example, if the IRS knows you have a traditional IRA worth $400,000 and you have turned 73, they expect to see RMD withdrawals on your tax return. If those withdrawals are absent or smaller than the required amount, that is a mismatch, and mismatches get reviewed. Here is where checking your bank account the wrong way enters the picture. Many retirees, especially those who are not accustomed to managing larger sums or who are less comfortable with digital tools, fall into financial habits that inadvertently create exactly these kinds of mismatches. They move money between accounts without documenting why. They make large cash withdrawals to cover home repairs or medical bills and pay contractors or providers in cash without keeping any kind of paper trail. They receive money from family members without understanding the gift tax implications. And every one of these situations, viewed through the lens of the IRS monitoring system, can raise red flags, even when the underlying intent was completely innocent. The Automated Underreporter Program. I want to tell you about something called the IRS, Automated Underreporter Program. Most Americans have never heard of it, but it runs continuously in the background, and it is specifically designed to catch exactly the kinds of discrepancies I just described. Here's how it operates. Every year, when you file your tax return, the IRS runs an automatic comparison between the income you reported and the income that third parties reported on your behalf. Your bank reports your interest income. Your brokerage reports your dividends and capital gains. The Social Security Administration sends a form called a 1099-SSA. Your retirement account sends a 1099-R. Every one of those documents gets matched against your return by a computer system. If there is a discrepancy, the system automatically generates a CP2000 notice, a letter from the IRS indicating they believe you underreported your income. For retirees, these notices are incredibly common because retirees often have multiple income sources they are not fully tracking. A little from Social Security, a little from an IRA, some interest from a savings account, maybe some rental income, maybe a small part-time job. When you are juggling all of those sources and doing your own taxes or using basic software, it is easy to miss something, and the IRS is counting on exactly that. The 5 dangerous habits. Now let us get into the specific habits that are causing real problems for retirees, because this is the core of what we are really talking about today. The first dangerous habit is what I call the daily balance checker. This is the person who pulls up their bank account every single day, sometimes multiple times a day, just to look at the number. And on the surface, that sounds responsible, right? You are staying on top of your finances. But here is the problem. Staring at your balance does not protect you from anything. It does not show you what transactions your bank is reporting to the government. It does not reveal what documents are being sent on your behalf. All you see is a number docs, and that number can be deeply misleading. If you have a savings account earning interest, that interest is taxable income, but it often goes unreported because people either forget about it or assume the amount is too small to matter. Your bank, meanwhile, is reporting every single penny of that interest to the IRS. So the habit of checking your balance without understanding what is actually being reported behind the scenes creates a dangerous false sense of security. You think you know your money, but you do not know the story your bank is telling about your money to the federal government. The second dangerous habit is the large cash withdrawal. And I know this one is going to resonate with a lot of people in our audience. There is a generation of Americans, particularly those who came of age before the digital era, who are simply more comfortable with cash. They do not trust online payments. They avoid credit cards. They want to physically hold their money. And that is completely understandable. But in today's banking environment, large cash withdrawals are one of the fastest ways to put yourself directly on the IRS's radar, because that $10,000 threshold triggers an automatic CTR report. And even if you stay below it, unusual withdrawal patterns can still generate what is called a suspicious activity report, or SAR. Banks can file a SAR anytime a teller or a bank manager observes something that looks out of the ordinary. Banks file hundreds of thousands of these every single year. Most of the people who get flagged have done absolutely nothing wrong, but once that flag enters the database, it gets reviewed, and reviews create paper trails. The third dangerous habit, and this one surprises people because it is the opposite of what you might expect, is ignoring your account statements. Many retirees set up their accounts, get comfortable with a familiar balance, and then stop actually reading their monthly statements. They glance at the total and move on. But buried inside those statements are items that matter enormously for your taxes: interest payments, fee reimbursements, bonus deposits the bank sent you for opening a new account. Even certain promotional offers from your bank can technically qualify as taxable income. If you are not reading your statements carefully, you are going to overlook those items when you file. And when you miss them, the IRS notices because your bank already told them. The fourth habit is one that has grown rapidly alongside new technology, and that is using multiple digital payment platforms without keeping any record of what flows through them. We already mentioned Venmo, PayPal, Cash App, and Zelle. But there are also retirees selling items online through Facebook Marketplace, eBay, or Etsy, and receiving payments they are not reporting. Here is an important distinction worth understanding. If you are selling personal belongings, used furniture, old clothing, household items at a loss, meaning you are getting less than you originally paid, that is generally not taxable income. But if you have a small side business selling handmade goods or providing services, and you are receiving payments through these platforms, that income is taxable. And under current IRS reporting requirements, those platforms are required to send you a 1099-K form once your received payments cross a certain threshold. If money is coming in through those apps and you are not tracking it and not reporting it, you have a problem waiting to surface. The fifth habit, and this may be the most consequential one of all for retirees, is giving money to family members without understanding the gift tax rules. I speak with so many seniors who are financially helping their adult children or grandchildren, maybe helping with a down payment on a first home, maybe covering part of a grandchild's tuition, maybe sending a little extra money each month to a family member who is going through a difficult stretch. These are loving, generous acts, but if they are not structured correctly, they can create real tax complications. Here is the basic rule you need to know. In 2026, the annual gift tax exclusion is $18,000 per person. That means you can give up to $18,000 per year to any one individual without needing to file a gift tax return. But if you give more than that to any single person in one calendar year, you are required to file Form 709, a gift tax return. Most people will never actually owe gift tax because of the very high lifetime exemption. But the form still needs to be filed. And if you are making large bank transfers to family members without filing that form, the IRS sees the transfer on your record. They do not see the return. And that gap is exactly the kind of mismatch that draws attention. What to do instead? All right, we have walked through all the ways things can quietly go sideways. Now, let us talk about what you should actually be doing, because this is Growth Horizon, and we are not here just to surface problems. We are here to give you real, actionable solutions that protect you and your retirement. The first thing I want you to do, and I would like you to do this before the end of this week, is pull your most recent bank statements and go through them line by line, not just scanning the total balance, but reading every single transaction, every interest payment, every fee, every deposit, every credit. Make note of anything that did not appear on your last tax return. I am not suggesting you did something wrong. I am saying that awareness is the very first step toward protection. The second thing I want you to do is call your bank and ask them directly what reports they are required to submit to the federal government on your account. Most bank representatives will be able to walk you through CTRs and the basic reporting requirements. This is information you have every right to know. It is not secret. It is just something most people never think to ask about. The third step, and this one is critical, is to collect and review every 1099 document you receive before you file your taxes each year. Every bank account, every investment account, every retirement account, every Social Security payment, every pension payment, all of these should generate a 1099 document. You should be receiving those either by mail or through your online accounts. Gather every single one of them before you sit down to file. Do not submit your return until you have all of them in front of you, because every 1099 the IRS receives is a data point they are using to verify your return. Miss one and the automated system catches it. The fourth thing involves cash. If you are not going to change the habit of using cash, and I understand completely if that is your preference, then at the very least protect yourself by keeping thorough records. If you withdraw a large amount to pay for a home repair, keep the contractor's receipt. If you pull cash for a medical bill, retain the explanation of benefits from your insurance. If you give cash to a family member, write a simple note documenting the amount, the date, and the purpose. These records will not prevent your bank from filing a CTR if the amount crosses the threshold, but they will protect you completely if you are ever asked to explain the transaction later. The fifth step, and this one is essential for anyone who is 70 or older, is to make sure you fully understand your required minimum distribution obligations. The IRS knows your age. They know what retirement accounts you hold. They know roughly how much is in them. And they know exactly when you are required to begin taking distributions. If you are 73 or older with a traditional IRA or 401k, you must be taking your RMDs every year. The penalty for skipping them used to be 50% of the amount you should have withdrawn. The law has since reduced that to 25%, and in some cases 10% if the error is corrected quickly, but that is still a substantial financial hit. And beyond the penalty, failing to take RMDs creates a visible red flag that can draw scrutiny to your entire financial picture. The privacy question. Now let me address something I know is sitting in the back of a lot of minds right now. Whether all of this IRS monitoring represents a genuine violation of your privacy as an American. I hear this concern constantly, and I think it is a completely valid one. There is a real and growing tension in this country between financial transparency requirements and individual privacy rights. The truth is, the reporting laws that govern bank activity were largely designed to combat money laundering, drug trafficking, and the financing of terrorism. They were never written with the average retired school teacher in mind, but they apply uniformly to everyone, regardless of intent. So the most effective way to protect your privacy is not to attempt to work around the system, because that can make your situation dramatically worse, but to operate within it in a way that is clean, fully documented, and defensible at every level. If every dollar in your account has a clear paper trail, if every large transaction has a documented rationale, and if every source of income is accurately reported on your return, there is nothing the IRS can do to you. You are untouchable. That is the goal. The expanding IRS infrastructure. Let me also take a moment to talk about something that has shifted significantly in recent years. The IRS has been substantially expanding its monitoring capabilities, with considerable new funding going toward hiring additional agents and investing in advanced data analytics technology. What this means in practical terms is that the IRS is now far more effective at identifying discrepancies that previously slipped through. Patterns that might have gone unnoticed 5 or 10 years ago are now being caught by sophisticated algorithmic systems, and retirees are actually among the groups facing increased scrutiny, not because they are doing anything wrong, but because retirement finances tend to be complex. Multiple income sources, multiple account types, layered tax rules. Complex situations create more surface area for discrepancies to appear, and discrepancies attract attention. Social Security and the taxation trap. There is one more thing I want to cover before we wrap up, and I think it is going to catch a lot of people off guard. Many retirees assume that because their income is lower after they stop working, the IRS is less interested in them. In some respects, that is true. The IRS has historically directed the largest share of its audit resources toward very high earners and large corporations. But there is a specific category of retiree that draws disproportionate attention, and that is the retiree who is collecting Social Security while also taking withdrawals from retirement accounts. Here is why. When you receive Social Security and also have other income, a portion of your Social Security benefits can become taxable. The formula is complicated, but the essential concept is this. If your combined income, which is your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefits, exceeds certain thresholds, then up to 85% of your Social Security becomes subject to income tax. A significant number of retirees do not understand this. They believe their Social Security is entirely tax-free. They fail to report it correctly. And then the IRS, which already has the 1099-SSA showing exactly what you received, sees a discrepancy immediately. If you are in this situation, drawing Social Security while also taking retirement account withdrawals, I strongly encourage you to sit down with a qualified tax professional before you file your next return. Not because you have made a mistake, but because the interaction between these two income sources is one of the most widely misunderstood areas in all of retirement taxation. And getting it wrong is one of the most reliable pathways to an unexpected letter in your mailbox. Digital monitoring and estate implications. Let me also give you a complete picture on the digital monitoring front. Your bank account is not the only window the IRS can look through. Third-party payment apps are now reporting to the IRS as I described, but there is another dimension most people never think about. What happens when you pass away? Your estate, including all bank accounts, investment accounts, real estate, and other assets, will go through a legal process after your death. and the IRS has significant authority to review the financial history of an estate if it suspects unreported income or unpaid taxes. So the habits you build right now, the documentation you maintain right now, the reporting accuracy you develop right now, these things are not only about protecting yourself today, they are about protecting your family when you are no longer here to explain things. The estate process is already emotionally and logistically overwhelming for your loved ones. The last thing you want is to leave behind a financial situation that creates additional legal or tax complications for the people you love most. Closing. Here is the bottom line, and I want to say it as plainly as possible. The IRS monitoring system is not going anywhere. It is growing more sophisticated with every passing year. And if you are 65 or older with money in a bank account, you are operating in a financial environment where transparency is not a preference. It is the law. But understanding that environment and moving through it intelligently is the difference between a retirement that is peaceful and protected and a retirement filled with stress, unexpected bills, and letters from government agencies you never wanted to hear from. You worked too hard for too many years to let that happen. You deserve to enjoy this chapter of your life without anxiety. And that is exactly what I want for everyone who watches this channel. If this video gave you something valuable today, something you did not know when you clicked play, I want to ask you to do 3 things right now. First, leave a comment below and tell me which part surprised you the most. Was it the bank reporting requirements, the structuring rules, the gift tax thresholds, the Social Security taxation issue? Let me know, because your feedback genuinely shapes the content I create for you. Second, share this video with someone who needs to hear it. A parent, a spouse, a sibling, a close friend approaching retirement. The information in this video could realistically save someone you care about thousands of dollars and a great deal of unnecessary stress. And third, if you are not subscribed to Growth Horizon yet, right now is the time. Hit that subscribe button and turn on the bell notification because we are delivering videos like this every single week. All of it designed to give you the real, unfiltered information you need to protect and preserve your retirement. Before I let you go, I just want to say something genuinely. Managing money in retirement is complicated. There are rules that seem designed to confuse you. There are systems running in the background that nobody ever explained to you. And there are very real consequences for making completely innocent mistakes. But you are not navigating this alone. That is what Growth Horizon exists for. I am OG John AG. Every video we produce, every topic we tackle, every piece of information we share, it is all for you. For the people who spent entire careers doing the right thing, paying their taxes, following the rules, and building a life through honest work. You deserve someone in your corner who tells you the truth, and that is exactly what we are going to keep doing. Thank you for watching all the way to the end. I will see you in the next one. Take care of yourself and protect your money.